All right, everyone. Bismillahirrahmanirrahim. Assalamu alaikum, everyone. My name is Yasir Yamin, and I welcome you all in this session. In today's session, we'll be going through one very simple and small area of IFRS 2. IFRS 2 is with the name of share-based payments. And by now, we already know what are share-based payments. Now, share-based payments are transactions where an entity acquires goods or services, and in exchange of those goods or services, either we settle that transaction in the form of providing shares, that is equity, to the other entity, or we provide cash, but that is based on the value of those shares. So in any case, IFRS 2 is all about share-based payment. Now we know how to deal with equity settled share-based payments, and we know how to deal with cash settled share-based payments. One of the finest examples of equity settled share-based payments is equity options. Now, under an equity option scenario, you are going to ultimately provide shares to the counterparty in exchange of goods or services. Now, how do you account for that transaction? Since most of the times you will be receiving services from your employees, that is the most common case for equity settled share-based payments, you'll be recording an accounting entry of expense debit and equity option credit. Now, this accounting entry will be measured according to the fair value of the option at the grant date, and there will be no mark to market. There will be no re-fair valuation at each reporting date. On the contrary, you also have transactions like cash settled share-based payment. The most common example of a cash settled share-based payment is the instrument SARS, right? Share appreciation rights. Now there you have promised the counterparty that in exchange of acquiring goods or services, you will be settling the transaction in the form of cash based on the intrinsic value of those shares. Now, under this type of a transaction, the entity has undertaken a financial liability. Financial liability means you have undertaken a liability, you have undertaken an obligation to deliver cash. Hence, you record an accounting entry expense debit liability credit. Now, remember, whenever you have a SARS scenario, share appreciation, right, or a cash settled share based scenario, you are always going to recognize the accounting entry. You are always going to measure the accounting entry based on the fair value of the instrument at the reporting date. And that means since you always have to use the fair value at the reporting date, you are going to mark to market with any gains or losses going into P&L. Yeah, automatically going into P&L. All right. Now, up till now, we have seen two types of transactions as we just discussed. But in practice, there can be one more type of transaction. Now, this is a transaction which we call under IFRS 2 a transaction with choice of settlement. I mean, this is a type of transaction which you can call a hybrid transaction, where an entity acquires goods or services, but in exchange of goods or services, you issue a hybrid instrument. A hybrid instrument is an instrument which contains the element of both. Either the transaction could be settled in cash, which is based on the intrinsic value of shares, or the transaction could be settled in the form of shares. Let me repeat it again. So under IFRS 2, there can be a third type of transaction. This is a transaction which is a hybrid transaction, whereby an entity acquires goods or services, but in exchange of goods or services, there is a choice. Either the transaction could be settled in the form of just like cash settled share-based payment, or the transaction could be settled in the form of just like an equity settled share-based payment. Now, the question would be, so normally whenever we have simple equity options, we treat those options like equity settled share-based payment. You just told us what to do. Otherwise, if we have share appreciation rights, they are treated as cash settled share-based payment, and you just told us what to do. But sir, what happens in a hybrid transaction? Now, there can be both consequences. It can be a cash consequence, it can be a shares or equity issue consequence. Sir, how do we account for these transactions? Now guys, the accounting for such type of an instrument or such type of a hybrid transaction, the accounting depends on actually who has the option to decide what is going to happen. I mean, there is a choice of settlement, right? Either the transaction could be settled in cash or the transaction could be settled in shares. But the point is, the question is, who is going to decide whether the transaction should be settled in cash or should the transaction be settled in cash? Now, there can be two options. I mean, in every share-based payment transactions, there are always two types of parties involved. One is the entity itself, and the other party is either your supplier or your employee. In most cases, share-based payments are offered to employees. So that is the more common scenario. Now, there can be two scenarios. Either we are going to decide that the transaction should be settled in cash or shares, or the counterparty, which I mean the employees, are going to decide how the transaction is going to be settled. Now, the transaction could either be settled by the way the instrument could provide that entity is going to make the choice, or the instrument could provide that the counterparty is going to make the choice. Now, the accounting depends on what is the scenario. Guys, first of all, we'll go through the scenario where we as an entity have a choice how to account for this transaction. If we have a choice how to account for this transaction, either we could settle it for cash or we could settle it for shares. If we have the option, IFRS 2 has a very specific guideline. IFRS 2 has a very, very, very specific guideline if we have a choice. Guys, the first case is where the company has the choice. Now remember, according to IFRS 2, if an entity has the choice, then the entity shall treat the transaction as cash settled if it has an obligation to settle in cash. You see, whenever you read accounting standards, whenever you go through accounting standards work within the mechanism of preference. Sir, what do you mean by that? So IFRS 2 wants to be prudent. So the first condition IFRS 2 gave is whenever the entity has a choice, the entity should account for that transaction as a cash settled share-based payment transaction. Can anybody suggest why under IFRS 2 the first condition says that the entity should account for the transaction as a cash settled share based payment transaction? I mean, they could have written you can account for this transaction as an equity settled share based payment transaction, but no, they first said that the entity should account for this transaction as a cash settled share based payment transaction. The first option is cash settled. Why? Can you guys suggest why? Why is this a scenario? Why are they talking about cash settled first and then maybe as you move on, equity settled next? Why? Any idea? Because the accounting standard wants to stay prudent. IFRS and IASB wants your financial statements to be prudent. And because they want their financial statements to be prudent, the first type of treatment that they are allowing you is cash settled share based payment transaction. Because everybody knows that if you account for this transaction as a cash settled share based payment transaction, then the accounting entry that you are going to prepare is expense debit and liability credit. In that scenario, you would be recognizing a liability in your financial statement, and it's more prudent to recognize a liability in your financial statement than recognizing an equity. And plus, if you account for this transaction as a cash settled share based payment transaction, then you will make sure that you mark to market this transaction at each reporting date. And that is why you will be reporting with timeliness the most faithful representation to your shareholders. Make sense? And that is why IASB or IFRS 2 said that whenever you have a transaction where the entity can make the choice, either go for cash or go for shares, it is a more prudent approach that first of all, you try to record this transaction as a cash settled share based payment. So what are they saying? They are saying an entity shall treat the transaction as a cash settled share based payment if it has an obligation to settle in cash. Now, how will you know whether the entity would have an obligation to settle in cash? This is the cash when the company cannot issue further shares. What are they saying? IFRS 2 is saying that please, accountant, be prudent. First of all, try to record this transaction as a cash settled share based payment transaction, and you need to find justifications for your decision. Look out, can the entity issue further shares? For example, there can be a practical limitation. There can be a practical limitation regarding issue of further shares. For example, for example, for example, the company has already utilized its authorized share capital. There can be, I mean, accountants should look out for chances where, how can this transaction be recorded as a cash settled share based payment. So IFRS 2 says you look out that whether the entity is obliged to settle this transaction in cash. Maybe look out for a scenario where the entity is unable to issue further shares, maybe because there is a practical limitation. Either there is a legal obligation that you cannot issue further shares, or there is a court case which bounds the company and it limits the company not to issue any further shares till the case is resolved. Or for example, the company has already utilized its entire authorized share capital, and since the limit has been reached, no further share issue can be made. If that is the scenario, try to record this transaction as a cash settled share based payment, because the reality is, the commercial reality is that if the entity cannot issue further shares, the entity will eventually decide to settle this transaction in cash. And IFRS 2 also provides another indication. I mean, look out for, is there a stated policy of the entity or a past practice that gives you guidance that entity will be settling in cash? IFRS 2 wants the accountant to look out for scenarios that can the entity issue further shares. Has the entity in past always settled these type of transactions in the form of cash? If that is the scenario, then the entity is eventually obliged to settle this transaction in cash, and therefore the entity should account for this transaction as a cash settled share based payment, even though the legal reality is that you have given the option, you have given a hybrid instrument to the other party. But still, since the transaction will eventually be settled in cash, therefore you should be treating this as a cash settled share based payment since the beginning, since the grant date. Understood? And then IFRS 2 goes on to say, otherwise, if the above is not met, if you can see that the entity has a practical ability to issue shares, if you see that the entity has in past also issued shares, that means the scenario is otherwise, then only as a residual option you are allowed to treat this transaction as an equity settled share based payment transaction. And under an equity settled share based payment transaction, you debit your expense, you credit your equity option, there is no mark to market, you measure this transaction at based on fair value at grant date. Understood, guys, just give me your feedback. Does everybody understand this scenario? Whenever you get a question in which you have a hybrid instrument issued and the entity has the option to decide whether they can settle, whether they have the option to decide if they can settle in cash or they can settle in the form of shares, first you look out for scenarios that how this transaction can be treated as a cash settled share based payment. You check out, is there any practical limitation, or how the entity has settled such type of transaction in past. If you get any hint that a transaction was previously settled in cash, then treat this transaction as a cash settled share based payment, or otherwise treat it as an equity settled share based payment. Is everybody clear on this? I want an answer from everybody. The entire class should answer. Is it clear to everybody? Say yes or no. Understood? Excellent, guys. Excellent. Very good. Now, the more interesting scenario, due to which we are studying this in this particular class, the objective of this class is the more difficult or more complex scenario where the counterparty has the choice to decide whether they want to exercise those options in the form of shares or cash. Yeah. Now, it can be both scenarios. It can be a scenario where your employee, who is the counterparty, he or she could decide whether they want to settle in cash or whether they could, whether they want to settle in shares. Or it could be a supplier. I mean, not an employee. It could be a supplier who decides if they want cash or if they want shares. Both the type of parties could be your counterparty. Now, regardless of who the party is, the accounting treatment is very similar. The accounting treatment is very similar. Sir, what is the accounting treatment? Let us go towards the next slide. Now, please, guys, focus. Focus. It is very important for you to focus on this particular scenario, because based on this scenario, I'm going to build up an example. The second scenario is pretty much different as compared to the first scenario. There, we had the choice to decide whether we want to settle in cash or shares. So we used to see our practice. But if you have issued an instrument where the counterparty, most likely your employee, has the option to decide if they could, if they want to settle in cash or if they want to settle in shares, you see, if the counterparty has the option, we can never go into their shoes and understand what they are actually feeling. Try to understand. If we as an entity had the option to decide whether we want to settle in cash or we want to settle in shares, we could have, we could have understood what we are going to do just by the way of our behavior, just by the way of our likeness or dislikeness. I mean, everybody knows about their own self, but you can never judge what I am thinking right now. You can never judge what the counterparty is going to do. You can decide what you are going to do, but you can never decide what the counterparty is going to do. So if the decision was in our hands, the accountant would look at the entity's past practices, or the accountant would look at the practical ability of the entity to issue shares, and then we could decide on our own. But whenever the counterparty has the choice, the employees have the choice, you can never go into their shoes, you can never go into their mind, you can never see what their heart likes, and therefore you cannot make a choice based on your own judgment, because you do not know the other party. Maybe some employees would go for equity shares, maybe some employees would go for cash. So you can never clearly decide what the counterparty is going to do. So you cannot make judgments. And that is why, what IFRS 2 says. IFRS 2 says that if an entity has issued such type of hybrid instruments where the counterparty has to decide if they want to settle in cash or they want to settle in shares, then believe you me, this is a compound financial instrument. This is a compound financial instrument. Do you guys remember where you have studied about compound financial instrument? This is a terminology that you must have studied in your previous paper in the past. From where did we get this terminology, compound financial instrument? Give me your best guess. So Asfa says, sir, IFRS 9. In actual terms, it is IS 32, presentation of financial instruments, but it is acceptable if you say IFRS 9. Under IFRS 9 or IS 32 to be exact, there was an instrument mentioned with the name of compound financial instruments. Now, compound financial instrument is any instrument which has two elements in it. Guys, do you remember your early years science classes? Do you remember when you were like in 7th, 8th, 9th, 10th grade and you were taught about sciences? In those times, you were told that a compound element is an element which has, a compound chemical is a chemical which has elements of more than one substance in it. Yeah. So more than one element combined together to make a compound. Likewise, the compound financial instrument is an instrument which has characteristics of more than one thing. So in our terms, a compound financial instrument is an instrument which has components of both debt, which is liability, and equity. IFRS 2 says if the other party has the choice to decide if they want to settle in cash or they want to settle in shares, there is a great likelihood that some people might settle in shares and some people might settle in equity. But at this point in time, we cannot make a judgment that after 3 years, 4 years, 5 years, whenever the vesting date expires, whenever the vesting period expires, we don't know what the counterparty's actual decision would be. So for us, right now, we have issued a hybrid instrument which could result in both ways. It could eventually lead us to a cash settled share based payment or an equity settled share based payment. So from our perspective, so from entity's perspective, it is a compound financial instrument. It is a compound financial instrument. And let us read whatever we discuss right now through the notes as well. IFRS 2 says that if the counterparty has the right to choose whether the share based payment is settled in cash or equity, then this is a compound financial instrument. Then this is a compound financial instrument. Guys, can you guys help me recall how did we used to account for compound financial instruments in IAS 32 or IFRS 9? Do you remember what was the accounting pattern for compound financial instruments? And I want answers from most of you guys, and you guys can give wrong answers. That is totally acceptable. Either way, even if you answer it correct, I'm not going to give you any Oscar award. So everything is acceptable. Do you guys remember what was the accounting terminology or accounting setup of compound financial instruments? No? Guys, under IFRS 9 or IAS 32, we used to do split accounting. If we have issued an instrument, which contains elements of both debt and equity, then we need to account for these transactions with both elements in it, debt and equity both. So remember guys, we used to do split up accounting. We are going to split up the debt component and we are going to split up the equity component. The debt component will be treated as a cash settled share based payment, and hence you will be recognizing a liability on that portion. The residual portion, the remaining portion, will be the equity component. It will be treated as an equity settled share based payment. And remember, it will be the residual portion that will be treated as an equity. Do you guys understand that we are going to do split accounting? I mean, you would be thinking, sir, how we are going to do split accounting? Leave that to me. But do you guys understand that this is a compound financial instrument where the counterparty has the choice to decide whether they want to go for shares or cash, and therefore for us it is a compound financial instrument and we must follow split accounting. Do you guys understand up till here? If you guys understand up till here, next I'm going to explain you how we are going to account for this transaction. Is everybody clear up till now? I want an answer from everybody, guys. Yes or no? Not only few people, I want an answer from everybody. Is it clear to everybody? A transaction where the counterparty has the choice to decide if they would want to settle in cash or shares. This is a compound financial instrument for us. And since this is a compound financial instrument for us, we will do split accounting. Now the question is, sir, how we are going to do split accounting? How? Guys, the answer is, first of all, what the format that you are going to follow is, and this format you are going to follow at the grant date. Each and every measurement is going to happen at the grant date. So the first thing that you are going to do is, you take the fair value of the instrument and you compare it with the fair value of the cash alternative. You take the fair value of the combined instrument, the instrument which has the options of both debt and equity. So you take the fair value of the combined instrument and then determine the fair value of the cash alternative. You determine the fair value of the cash alternative, and all of this is happening at the grant date. If, for example, the fair value of the entire instrument is, let's say, worth $10,000, and the fair value of the cash alternative, fair value of the cash alternatives mean how much value will the holder get if they wish to settle in cash. So for example, the fair value of the cash alternative comes up to be $8,000. Then the residual portion of 2,000 will relate to the equity option. We are going to take the entire instrument's fair value, which is the hybrid instrument. We are going to take the hybrid instrument's fair value. All right, guys. Then we are going to compare this with the fair value of the cash alternative. What happens to the holder if they settle in cash? If the value of the entire combined instrument is 10,000 and fair value of the cash alternative is 8,000, then this automatically means that the remaining 2,000 relates to the equity option. The remaining 2,000 is related to equity option. Sir, we have a question. Sir, we have a question. A quick question, sir. Sir, is it possible? And you guys are going to give me the answer. Use your common sense, guys. Use your common sense. Sir, is it possible that the fair value of the entire hybrid instrument is 8,000, whereas fair value of the cash alternative is 10,000, and therefore we get a negative answer? Sir, is it possible? Sir, is it possible? You guys give me the answer. Is such a scenario where you get negative equity portion, is it possible? Everybody, please answer. You have to stay focused and you have to, you have to correspond with me. Yeah. So is this scenario possible? The answer is absolute no. It doesn't make any sense. Let me give you an example, guys. Let me give you an example. Let me just pick up two things and let me give you an example. Let's say here is an instrument and I am giving you an instrument. Now, if you take this instrument from me, you will have the option to either settle in shares or cash. And this is another instrument. This is another instrument. And here you only have the option to settle in cash. I will give you your money back. Here you can even ask for shares of our business, this business. And here I will only return you some cash. Which type of instrument do you think will be more valuable for you as a holder? Which type of instrument would you prefer? This pencil or this plug? Just think about it. Here you can only have cash. Here you can also have cash, but also you will have the option to ask for shares, to ask for equity in this business. Which one is more valuable for you? Let me know. The pen or this plug? Which one is more valuable for you? Yes, sir, pencil. Sir, obviously pencil is more valuable for us. Why? Because if you take this pencil, eventually you can ask for cash. But still you have an option. Still you have an option to ask for shares in this business. In this business. So logically speaking, this is a more valuable instrument for you. This is a more valuable instrument for you. So guys, always remember common sense. The fair value of the entire instrument can never be less than the fair value of the cash alternative. You guys answered your own self. This will always be with a higher value and the cash alternative will always be with a lower value, and hence you will always get a positive residual equity option portion. Understood? Guys, understood? Do you guys understand or not? Please let me know Y or an N. Is it clear to everybody? So this is the format that you are eventually going to follow. You have the objective of splitting up the cash portion, the cash settled share based payment portion and the equity portion. I hope this is clear to everybody. Done. Now, sir, the question is not about the understanding itself. The confusion is how are we going to account for such a transaction? How are we going to resolve it? No worries. No worries. Let us do an example on it. No worries. Just plain, simple, vanilla example. Yeah. Just see. And please, I want your feedback on this very quickly. Okay. So here is an example and we are going to solve this example, right? So it says on 1st July 20x1, Smeaton grants an employee right to choose. You grant an employee right to choose. Who has the option? Who has the option? The counterparty has the option. On 1st July X1, Smeaton grants an employee right to choose either 20,000 shares on 30th June 20x4 or cash or cash for 18,000 shares at that date. My dear fellows, today is 1st July 20x1. We are promising to our employees, we are granting an option to our employees that on 30th June X4, which is approximately 3 years after. So after 3 years, the employees would have an option. The employees would have an option. Either they could take 20,000 shares from the company, or they could take cash at the value of 18,000 shares. They could take cash at the value of 18,000 shares. And since employee has the option to decide what to do, this is supposed to be a compound financial instrument, and it is supposed to be treated accordingly. Understood? Understood? So what do you guys need to do? At the grant date, you need to determine how to account for this transaction. You need to determine how to account for this transaction. You need to do split up accounting. You need to do split up accounting. Sir, how we are going to do that? Just follow me, please. The employee must remain employed on 30th June 20x4. That means this is a with service condition scenario. This is a with service condition scenario. Now examiner says market price of shares at grant date is $5. So at grant date, the market value of the entire instrument, which has the option to provide shares is $5, right? $5.35 on June 20x2, $5.80 on June 20x3, and $6.10 at June x4. Now, these are the prices for the option given for later stages. It is 30th June x2, 30th June x3, 30th June x4. At this moment in time, we are only concerned about the grant date. Clear? And at grant date, the instrument has a fair value of 5. Examiner says, however, the fair value of the shares route is 4.90. Now just understand how we are going to determine. Please look at me very carefully. It says, you see, either the holder of the option could simply go for shares, or the holder could go for cash. Either the holder of the option could go for shares and get the entire or some portion of equity in the entity. That's a bigger thing. Or you could just settle for cash. Now, if an employee settles for shares, then what will be the scenario? The employee would be getting 20,000 shares. Which are at this date worth 4.90. So what do you do? Can anybody do 20,000 into 4.9? Please. I have a calculator, but seemingly it's not working at this moment. Can anybody calculate what is 20,000 into 4.9? 98,000. So the first option could be that any holder, whether be it an employee, or it could have been a supplier as well, if they went for the shares option, they would get 20,000 shares, and these shares are worth 4.90 as is written. The fair value of the shares route, the option value, the fair value of the shares route means the options value is 4.9, and that means the entire equity option, is worth 98,000. The alternative could be that the shareholder goes for the cash option. If they go for the cash option, they would only be getting 18,000 shares, and at this cash based on the value of these 18,000 shares, and if they were to get cash based on the value of these 18,000 shares, the cash value of these shares right now is $5. So can anybody do 18,000 shares into $5? Either they go for an equity option. If they go for an equity option, the option in itself is worth 4.90 per option, multiply by 20,000, the entire worth is 98,000. If they went for cash option, then they will be getting cash based on the value of 18,000 shares, and at grant date these shares are worth what? 90,000. So you see the cash alternative is worth 90,000. The entire instrument, which could have given you cash or equity, the entire instrument is worth 98,000. Within this 98,000, the cash alternative is worth 90,000. So can you guys tell me what will be the worth of the equity option? What will be the worth of equity option? Can you guys tell me? Remember, equity option is always the residual portion. Even the definition of equity is the residual amount of interest in the assets of the entity after deducting all its liabilities. Remember, equity is always the residual portion. So for example, if I were to provide you the option of this pencil, remember, all of you guys agreed that taking the pencil is a better option. And why did you think that taking the pencil is a better option? But because eventually you knew in your mind that in any case, we could get the cash. Plus, this pencil has some equity worth in it as well. You can eventually settle for cash. But so additionally, it has some equity value as well. So equity is always the residual portion, and that means equity option would be worth 8,000. So the entire instrument, guys, the entire instrument is worth 98,000. The cash settled alternative is now currently worth at 90,000, right? And the equity settled portion is now worth 8,000. The cash settled portion, which is determined based on the fair value if cash was to be given. If the cash settled share based portion shall be treated as a cash settled share based payment, and that means you will be recognizing a liability against it. You will be measuring this transaction based on fair value at reporting date, and plus also mark to marketing this transaction always. As far as the 8,000 value of equity settled portion is concerned, remember, this will be treated as equity settled share based payment. And since this is to be treated as an equity settled share based payment, remember, you will be measuring this transaction based on the fair value at grant date, and plus there will be no mark to market. There will be no mark to market. Is it understood by everybody? How do you do split accounting? You determine the value of the entire instrument, yeah, and you compare it with a cash settled alternative. The residual portion is always the equity option. Is it clear to everybody? The question is not yet complete. If you have understood up till now, I'll have to move on and discuss how equity and cash settled alternatives are going to be treated in each of the 3 years of the vesting period. Is it clear to everybody up till now? Till now, we have segregated the entire instrument into two areas, cash settled separate and equity settled separate. Is it clear to everybody till now? Give me a yes or a no, guys. Give me a yes or a no. Done. Done. Excellent. Guys, now you guys know that the equity settled option has a worth of $8,000. And remember, this $8,000 was determined at the fair value of the grant date. And since this 8,000 was already determined at the fair value at the grant date, and there is no mark to market, this figure will never change. This figure will never change. This figure will never change. Sir, so what do you actually do? So in each of the 3 accounting periods to come, let's say the first accounting period would be on 30th June X2. 30th June X2. You know what is the total value of your equity settled share based payment? And this was determined based on the fair value at grant date. This was determined based on the fair value at the grant date. The entire equity settled share based payment is worth 8,000. But you are not going to recognize the entire 8,000 in period 1. You are not going to recognize the entire 8,000 in period 1. Why? Because this was a question with service condition. And if this was a question with service condition, then you know at the first accounting period it is going to be 1/3, at the second accounting period it is going to be 2/3, and at the last accounting period it is going to be 3/3. You apportion the impact. You apportion the impact. Understood, guys? So how are you going to treat the equity settled share based payment? Guys, just follow. $8,000 multiplied by 1/3. This is related. This is the expense relating to the first period. Can you guys tell me what is the value? Can you guys tell me please what is the value? So I do $8,000 divided by 3. This is $2,667. Actually, I'm faster than you. What is going to be the accounting entry for this 2,667, guys? The accounting entry is going to be expense debit 2,667 and equity option credit by the same amount. Is it clear to everybody? Sir, what are we going to do in the next year? What about 30th June X3? My friends, it is very easy. It is very easy. You first determine what should be the as-at figure. Now, $8,000 was the complete figure for 3 years. As at 30th June 20x3, 2 years have passed in the vesting period out of 3. So you do multiply by 2 divided by 3. Can anybody tell me what is 8,000 divided by 3 multiply by 2? Guys, this is 5,333. Make sense? But are you going to recognize an accounting entry for 5,333? The answer is no. What are you going to do? You are going to write already recognized. You are going to write already recognized. What is the amount of expense that we have already recognized with regards to this share-based payment? We have already recognized 2,667 in past. Here it is. Understood? What is going to be for the year impact? For the year impact is going to be again the same 2,667. Understood? Is it clear to everybody? Sir, what is going to be the accounting entry in this period? Same. Expense debit 2,667. Equity option credit 2,667. The same accounting entry. Is it clear to everybody? Come on, just let me know if it is clear to you. Sir, what are we going to do in the third and the last year? 30th June X4. Any idea? Sir, same. As at $8,000 multiply by 3/3, which will equal to $8,000. Sir, we will subtract already recognized, whatever has already been recognized. What is the value of already recognized, guys? What is the value of already recognized? In the first accounting period, we recognized an equity option value of 2,667. Then we again recognized 2,667, which is equivalent to 2 years value of 5,333. So guys, what is the total? For the year? 2,667. What is going to be the accounting entry again in the third year? Expense debit 2,667, equity option credit 2,667. Is it clear to everybody? Guys, just give me a yes or a no. Is it clear to everybody? I'm talking about equity settled share based payment. Thumbs up. Clear for everybody? Guys, if this is clear to you, now we have to move on towards the next portion. And I would really like if you can tell me how to account for cash settled share based payment. Definitely, it's not the same manner. It's not the same thing as equity settled share based payment. Now, under a cash settled share based payment, remember, the value is not locked. You have to measure this transaction based on the fair value at your reporting date, and that means you always have to mark to market. You always have to mark to market. Sir, so what happens on 30th June X2? Can you tell us? Why not? At 30th June X2, as at. So the transaction could have been settled in cash. And how it could have been settled in cash? You would get the cash based on the value of 18,000 shares. You could get cash based on the value of 18,000 shares. So 18,000 shares is very important, right? Can you guys tell me how am I going to measure these 18,000 shares? Previously, what I did was I took 18,000 shares and multiplied them by 5. Am I still going to take 5 in my calculation at 30th June X2? Am I still going to take 5? No, 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 sir. Sir, remember, mark to market. That means you take fair value at the reporting date, which is 5.35. So 18,000 shares multiplied by 5.35 for every SAR or every share. But should I recognize the entire amount? Whoa. Somebody said 96,300. Should I recognize the entire amount? No, 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 guys. Guys, this transaction has a 3-year vesting period and all employees must remain employed during that period. So it's a with service condition question. Guys, if this is a with service condition question, then we have to multiply it by 1 and divide it by 3. Remember? So what is the value now? Can anybody tell me? 18,000 shares multiplied by 5.35 divided by 3. This is 32,100. Excellent. Can you guys tell me what is supposed to be the accounting entry for this 32,100? Can anybody tell me? Expense debit 32,100 and your liability credit 32,100. Understood? Is it clear to everybody? Done? Very good. Very good. Done. Excellent. Sir, what should be the accounting entry for 30th June X3? How should we account for it? Guys, tell me. Again, we will determine what has to be done as at. These will be 18,000 shares again. But right now, since we have to mark to market, we will take the fair value at reporting date. Fair value at reporting date on 30th June X3 is 5.80. So I take 18,000 shares. Multiply it by 5.80. Guys, this is 104,400. But then I also 5.80. But then I also multiply it by 2 and divide it by 3. Can anybody tell me the answer? Or I do it myself? Please confirm if the value is 69,600. Very good. Excellent. Now then what do? We subtract already recognized. The value of already recognized is 32,100. And that means for the year value is supposed to be what? 37,500. Excellent, guys. Then dear, what is supposed to be the accounting entry? Expense debit 37,500 and liability credit 37,500. Done? Clear for everybody? Okay. Sir, what do we do in the last year? 30th June X4. Can anybody help me out with this? 30th June X4. As at, these are 18,000 shares, right? Multiplied by, what is the fair value at reporting date? 6.1. Please someone calculate it for me. Multiplied by 3 by 3. What is the value now? Then you will eventually have to subtract already recognized from here. The total is 109,800 minus 69,600 for the year. Value is 40,200 And that means the last accounting entry is going to be expense 40,200 debit and liability 40,200 credit. Is it clear for everybody? Is it clear to everybody? Is it clear now? If it's clear, I must ask you a question. Let me ask you a very simple question, a very conceptual question, not a difficult one. In the case of cash settled share based payment, what we did was that we recognized an expense 32,000 in the first year, 32,100 in the first year. And in the second year, we recognized an expense of 37,500 in second year. In third year, it was 40,200. If you accumulate all these, this is certainly an expense worth more than 90,000. It's fairly simple. 32 plus 37 plus 40 is definitely more than 90. But initially, you recognize that the cash alternative has a value of 90,000. How is it possible that something which had value of 90,000 and against it an expense of more than 90,000 has been recognized? Why is that so? Initially, we determined that the cash alternative would have worth of $90,000, but here we are recognizing an expense of almost 109,800. Why is that so? Any ideas? Why is that so? Yes. Excellent. Excellent answer. Because we mark to market. Because we mark to market. You see, in an equity settled share based payment case, we don't mark to market. So eventually, in 3 years, the total expense recognized was 8,000 because we don't mark to market in equity settled share based payment. But under cash settled share based payment, the initial value will never correspond to the cumulative value of all those 3 years because we mark to market. All right. Fair value will change each and every reporting date. And that is why the initial assessment, although it was based on $5, now in each year it was not worth on $5. Hence the value will change. Clear? Done? So guys, just let me know if this is clear or not. I want your feedback. Confirm everybody.